Good morning, everyone. Welcome to this update for global stocks and commodities for the 29th of January. Not a lot happened during the week, so this will be a bit of a shorter video. The outlook remains very positive, particularly in America, and I guess our poor old market is really not doing very much. It just regained the losses of the previous week, and just so much of our market is really just churning up and down in a fairly narrow sort of band. Quite uninspiring. Anyway, let's have a look at the bigger picture. We'll start with American stocks, and the S&P did manage to advance by 24 points on the week, so quite positive. And we continue this stair-step uptrend that I covered in greater detail last week. The VIX is down to 10.5, which is close to all-time lows. I find that quite amazing, given that we're in a period of unprecedented change, and that was before Donald Trump. And now with Donald Trump, uncertainty reigns. We've got a tremendous amount of uncertainty in Europe, and the future of the European Union certainly has a bit of a cloud over it. So how the VIX can be at 10.5 is a bit of a mystery to me. So there are certainly some great inconsistencies in the market at the moment. One of which is that the level of bullish sentiment in America, conducted by formal surveys every week, has dropped quite significantly in the last 2 weeks, by 5 percentage points each week, and we've now recorded 108 straight weeks where sentiment has been below 50%. So the people that are trumpeting the fact that the market has gone too far, that people have flooded into the market and pushed it up to these highs that are unsustainable, are either have no idea what they're talking about, or are just talking their own particular book, and they would like to see the market lower because it just isn't factual. On the S&P, having said that, however, technically the market has been up for a long time, and a bit of an easing off would certainly be helpful. And so there is a retracement zone which would extend from just under 2,200 points to 2,232, and the market is currently around 2,290. So there's the possibility of 60 to 90 points of downside in the S&P. But to put that in perspective, it went up by 24 points last week, so it's not that much really. Earnings are critical, obviously. A lot of people are trying to say that this rally is purely about Trump. Again, that is a misconception. It is an assumption that people are making, which is wrong. The market is reacting very much to the perception of where future earnings should be, and those earnings are being delivered, and particularly in the energy sector, semiconductors and financials are doing well. To date, 34% of the S&P 500 companies have reported earnings, and 65% have come in above expectations, which is about normal. It's generally somewhere between 63 and 70% beat expectations, so we're pretty much on track. What has improved is that the forecast for earnings growth was 3.1%. It's actually at the moment coming in at around 4.2. So, if you want to try and examine why the market is going higher, then you really need to look no further than that number right there. Earnings growth is coming in higher than expectations that was set back in December. And so, of course, stock prices are going to move higher. There's no real mystery about that. The forward PE, so that's the 2017 PE for the S&P 500 as a whole, is currently sitting at 17.2. That is fractionally above the very long-term average. However, that long-term average, it relates to an interest rate level that's much higher than where we are now. So 17.2 in the kind of interest rate environment we're in at the moment is not expensive. So again, ignore the people that want to tell you that they use the CAPE ratio, or there's all sorts of ratios out there to try and demonstrate that this market is expensive. It's just cherry picking the numbers for them to say what you want to say. Again, I think that number is it's simple, it's realistic. 17.2. It's about 1.5% or 1.5 points above the very long-term average, which would be a 10-year yield of around 4 or 5%. The 10-year yield at the moment, of course, is well below 3%. So I think that's fine. And finally, I get concerned when sentiment gets over the top. We saw that in the first half of 2016 when sentiment towards gold stocks became excessive. And so the correction that we got in precious metals in the second half of last year was predictable, perhaps not to the extent, but certainly the correction was predictable. But on that score, bullish sentiment, as I indicated before, has dropped from 37 to 31.6 in the week. It's the second decent fall in 2 weeks, and it's the 108th consecutive week where bullish sentiment was below 50%. So you cannot tell me that sentiment is through the roof and therefore that most people's money are in and therefore the market is at risk of a top. It is just not factual to say that. So just discard that theory. Let's have a look at the S&P itself. You can see we had a period of stability, very tight range from mid-December until Tuesday when we got a nice jump, and then the market really didn't do much after that, but it's just bordering on 2300. I've just popped a little Fibonacci scale on that, and I could probably raise that a little bit, and therefore we get downside support targets. There's one here at 2230 and then 2217 and perhaps 2191 down to the 50% level, and also these highs back here. So that's all very neat, which I quite like. So somewhere between 2190 and 2232 should be the retracement zone, unless of course we push on higher before that correction occurs. Now, a lot of the strength has been in the NASDAQ and technology sector, and it just continues to power on. It's probably run pretty hard. So I think if there is going to be a bit of a correction, it's just because perhaps this part of the market did get ahead of itself. But the earnings for semiconductors are coming through really well. There was a terrific earnings report out from Skyworks early in the week that showed excellent profit and sales growth. Alibaba came out with a sensational report, 50% growth in sales and profits. So whilst these prices are moving up, by gee, the earnings and sales growth is there to support them. So I'm not terribly concerned about it at the moment. I think it just creates perhaps some short-term technical downside. Now the US dollar managed to hold just around about this 100 level, so it's just bouncing just slightly below it and slightly above it. Whether this is a consolidation and then we get another bounce, or whether we get a break of 100 and it heads lower, I don't really know. It probably depends to a degree on what happens with the euro and the Japanese yen. If they get bid up, then the US dollar will fall. But I'm not particularly focused on that at the moment. Turning now to the Australia. I'll just have a look at the VIX index. So there's the VIX index. Sorry, that's not the VIX index. This is the VIX index. So you can see if we pan back and take a look, we're really plumbing the absolute lows. It rarely gets down below 10. In fact, this is the VXO. So this is the VIX index on the S&P 100. So it's just below 10 on the VXO. It's 10.5 on the VIX, which is just a slightly different index, but they mean the same. It's basically all-time lows, and it's generally not sustainable at this level for too long. So I expect to see a bit of a spike up into perhaps the 15 to 20 range. I think that that is probably how things are going to play out. That'll probably be fairly short term, and then the VIX will start to decline and stocks will start to go up again. So I think that's really the overall expectation at the moment. Now turning to the Australian index, not a lot of movement here. You can see we had 2 decent days down on Friday of the week before last, and then Monday, and then we got 3 solid days back, Tuesday, Wednesday, and Friday, to basically recoup those losses. But not a lot happening in the Australian market outside the banks and the major miners. The Aussie dollar steady at 75.5, and our index was higher by 60, but just recapturing the losses. Turning now to precious metals, and I thought this week I would just look at silver. Normally focus heavily on gold, but silver's interesting. The costs for silver miners and profit soared in the third quarter. We don't have the fourth quarter numbers yet, but from Q2 to Q3 last year, the average cost of production, all-in sustaining cost, fell, and the average realized price for silver rose to around $19. So that meant that the profits soared, and that happened at a time when stock prices crashed. So that was due to that crash was due to some other factors that I'll get to in just a minute. But make no mistake that the underlying fundamentals with silver and gold stocks is improving and improving quickly. And ultimately, that's what determines the price in the medium to longer term. Now, silver tracked gold lower in the third and fourth quarter. In the fourth quarter. And that was thanks to 3 major sell-offs, and they were all due to transitory triggers in the second half of last year. There was Brexit, and then there was Trump's election, and then there was the Fed raising interest rates. And each of those 3 triggers led to a cascade of selling that, as I've explained in previous weeks, just basically feeds on itself and becomes self-sustaining for a period of multiple months. And we just see that over and over again. And so even though the profitability of silver miners soared in Q3, the price of silver, the stock still managed to go down quite significantly. So what should have been just a normal correction in gold and silver actually turned quite ugly. But a new major up leg in silver appears to have started. The ratio of silver to gold is way above where it should be. So therefore, we could expect a reversion to the mean, and therefore expect silver to do better than gold in the ensuing period. And of course, if that happens, then even if gold doesn't rise, then silver stocks, the profitability is going to soar again, and the market will stand up and take notice of that. Gold was lower by $16 on the week, and that was partly about the currency, about the US dollar. There was a couple of days there where the US dollar bounced a little bit, but look, it's really just a bit of a pullback. We'll look at that in a minute. And of course, gold stocks were marginally higher. So let's take a look at precious metals. So this is gold. Let me zoom in here and give you a closer look. So we've had a really strong rally off the lows, and I've just put a simple Fibonacci scale on this. The first level, the 38.2% level, came in at 1183, and you can see we tagged that level on Friday night, and then turned around, closed on the highs, and actually made a slight gain on the session. So it's not definitive proof, but it's not a bad start. Silver, on the other hand, had quite a good night on Friday, as you can see. Didn't have that experience that dip, has not pulled back as far as gold has from the latest rally, and that was quite a positive finish. So silver stocks looking pretty good. If we look at GDX, the stocks haven't really done a great deal, but then that's in itself a positive, because during this period when the gold stock indices have stayed steady, gold has actually come off the boil a little bit. So again, gold stocks seem to be leading in the upwards direction, and that's a positive. Now, the only other point of note on gold is that the amount of gold holdings in GLD, which is the world's largest ETF, actually slipped below 800 tons. They come down to 803 and then held some stability there, and it got back up to 810, but then fell again under 800 briefly during the week. So ETFs, the investors buying into ETFs still have not bought into this gold rally yet. And that just further underscores how impressive this performance by precious metals and by precious metals stocks has been when there's not this big surge of money into the ETFs. Copper higher to $2.67, and base metal stocks are really soaring. They've done really well. Copper, nickel, lead, and zinc have all done pretty well. Crude oil steady at 53, and still really no definitive move in the energy stocks as yet. Although of course uranium stocks have done exceedingly well. There's the spot copper chart. Not a lot of change there. So to wrap it up, and I just keep reinforcing this point, so critical, and most people do it poorly, I'm sorry to say. Be very clear about your strategy and be very clear about your process, and develop the discipline to stick to your process. Your process won't always work for you through all market conditions, but you've got to engender the confidence to stay with a system that is productive, and not chuck it out the minute that the market doesn't deliver you a positive result. And I've been working with clients closely for 15 years, and I just see it over and over again. Traders and investors get one little burst of bad outcomes, and they throw out their methodology, and they go and look for another one. It's just the worst possible thing that you can do. Now, traders and investors can't avoid risk, so stop chewing up energy trying to avoid risk. If you want to be long-term profitable, then simply you just need to avoid making big mistakes at the wrong time. And that comes back to having a pretty clear view of what's going on in the various stock, currency, and bond markets. And that's what I try to deliver to you through these weekly videos. It's really just to give you a perspective so that you can avoid making big mistakes at the wrong time. Don't overreact to short-term fluctuations, because there's every chance they'll reverse, and absolutely ignore the herd. In fact, if the herd is all thundering in one direction, then you really want to be looking for opportunities to go the other way. I really think that a couple of months of reaccumulation is likely. We might get a correction from here. We might push a bit higher. I don't know. It doesn't really matter. But there will be a bit of downside and fluctuations. But I think overall, it'll probably add up to a period of reaccumulation. And again, I covered that in last week's video when I looked at the stair-stepping pattern that we've seen through 2016. If you didn't see that video last weekend, then I suggest you go back and revisit that, because it'll just give you a useful perspective on what to expect from the S&P from here. My personal view on what I see, not born on any particular bias, but just what I see. And as you know, I trade what I see and not what I believe. I expect to see stocks stronger. I expect to see commodities stronger, and I expect to see bonds weaker, although we may get a rally in the short term. So that's pretty much the playbook that's unfolding. And don't underestimate the power of positive expectation. Whether you love him or hate him, Donald Trump is providing something that's been absent in the American economy and the American psychology for a long period of time. Since Washington has been hijacked by Wall Street, and I don't think there's any question about that. There's been a long period where the elite and those in power have been favoured, and I think the general population and also business, there's been so much government regulation that it's been very difficult for business to invest with confidence. Trump is turning that on its head. And so don't underestimate the power of positive expectations. Even if Trump doesn't immediately deliver positive results, and it will take a while for them to follow through, just the expectation that things are getting better are going to cause businesses to invest. They're going to invest in capital. They're going to employ more people. They're going to have a more positive attitude, and that flows through to the rest of the economy. People spend more, and the whole thing becomes self-sustaining. So just don't underestimate the power of what Trump is bringing to the equation. So that's it for this rundown. For non-members, there's my contact details. If there's any way that I can assist you, then please let me know. Otherwise, I think we've got another fascinating week. In fact, I think I can say that every week while Donald Trump is president, because anything is possible. Cheers for now, and talk to you next week. Cheers.